Hi, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago, talking S&P futures. Essentially unchanged, very quiet day in the S&P, which is strange because the moves in the S&P in July have actually been a little bit wider than recent months if it were to continue the way it has for the first 17 days or so of July. The S&P futures are almost laser focused right now on bond yields, and part of that has to do, that minute-to-minute focus on bond yields and really 10-year note yields has a lot to do with bank earnings, but I'll talk about that in a second. The bond yield on the yield on the 10-year note rather hit 2.309 today, which has actually backed off a little bit from the move it did last week. Last week we got a pretty decent sell-off on Friday in terms of bond yields. Bond yields went much lower after we got the weak CPI data, the weak retail sales, and the average industrial production. And that, again, is where bank earnings come into focus. We had bank earnings last week. We had PNC, we had Wells Fargo, JP Morgan, and Citigroup. And now this week we've got BlackRock Incorporated, who essentially is a bank. We've got Goldman Sachs, we got Bank of America, and we've got Morgan Stanley. That's all this week. Now, last week we had the bank earnings beat pretty handily, except for Wells Fargo's revenue number. Everything else beat, all the earnings per shares and all the revenue numbers, again, except for Wells Fargo. And we saw bank stocks fall, and that was because bond yields fell. So what's the easy money for banks? The easy money for banks is a steep yield curve. That's when bond yields are rising, and the front end yields that's controlled by the Feds stays low, so that steepens, they borrow at a lower rate and lend at a higher rate. And when that flattens out, when you see the bond yields and the 10-year note yields falling like we have Friday and today, that tends to hurt bank stocks. Now, the interesting thing about it as well is that when the bank stocks fell because of the weak economic data, that took the central bank for the U.S. out of the picture at least, or pushed back any sort of aggression that might come, aggressive removal of accommodation. It pushed that back, which caused stock to rise. And central banks are still on the mind of the markets right now, especially the global central banks are definitely in the market's crosshairs. And the reason I say that is because this week we've got an ECB rate decision, we've got Royal Bank of Australia minutes actually tonight, and we've got a Bank of Japan rate decision on Thursday, as well as the risk bank, which won't affect the U.S. as much. But the Bank of Japan is expected to do nothing unless the yen weakens toward 120. But the ECB is under a little bit of pressure to raise rates. So is the Bank of England, but their meeting's not this week. They're under a lot of pressure to talk about raising rates or talk a little bit more hawkishly, and especially talk about ending their asset purchase program and potentially when they're going to end the reinvestment that the U.S. Fed says that they're going to do starting sometime late this year. So central banks matter again this week, and bank earnings matter again this week. But for today, neither one of those things were in the news, so we end up with an essentially unchanged S&P 500. This is Bob Iaccino talking S&P futures from the CME Group trading floor in Chicago.